We were encouraged to kind of narrow our topic, since financial regulation is a very broad topic, into pieces that we were particularly interested in. So I'm going to use my time to talk about mortgage regulation, mortgage policy, which was an area that I worked on a bunch when I was at the Treasury Department, and I want to share some thoughts about how we were thinking about it. So with this slide, I'm going to give you some background on key institutional and regulatory developments in the mortgage market since the financial crisis. So this is, of course, a very kind of complicated topic. A ton has happened. So I'm not going to do it justice, but I'm going to distill it down into 3 bullets. So the first thing you want to understand is that Fannie and Freddie, the GSEs, they were put under government control in 2008. So Fannie and Freddie, those are the big financial institutions in this country that buy and securitize what people would consider to be kind of garden variety American mortgages. So fixed rate, 30-year, not too big, not too risky, or supposedly not too risky loans. So it's been 8.5 years, and those 8.5 years have been full of talk about how we really need legislation that establishes a new permanent mortgage finance regulatory framework. However, Fannie and Freddie have remained in conservatorship. There has been no such regulation, or legislation, sorry. Second development I want to note is that new activity in the private label mortgage-backed securities market it dried up during the financial crisis, and it never revived. So it's kind of a striking thing, and as an aside here, I will note that I'm really glad that you are featuring this paper this afternoon on the housing boom, because the paper makes a point that is also made in some very interesting work by Chris Foote and Paul Willen and Lara Lowenstein, that basically the excessive borrowing and lending that occurred during the financial crisis, it was across the credit spectrum. It was across the income distribution. So this view that somehow the PLS market was disproportionately responsible, it's just wrong. And I'm glad kind of the narrative is now being clarified. Third development I want to highlight is that there has indeed been some constructive regulatory progress in the mortgage area. There are new Consumer Financial Protection Bureau rules that better protect the consumer. There are stronger capital standards for banks, which certainly which apply to mortgages, and certainly help make the banking system safer. Okay. So now I want to take a minute to talk about what I see as the current situation in mortgage markets and what it implies for macro growth. So the number one concern that you hear people express is that the supply of mortgage credit looks like it's still tight. So here are a couple of charts that kind of make that point. So on the left, you can see mortgage purchase originations. And what you see in that chart is they dropped a bunch after the housing boom during the bust. And they've come back up, but they've only come back up to their 2002 level. And just to appreciate how low that is, you need to realize that the number of households is up by 15% since then, and this measures in billions of dollars. House prices are up by more than 50% since 2002. So this is a low level that we're at now. And then the graph on the right shows you credit score at origination for mortgages. So it shows the median, it shows the 10th percentile. And what you can see is that credit scores went up a bunch during the financial crisis, and they really haven't come back that much, or come down that much. They remain well above where they were in 2002. So this is kind of pre-boom. Okay, so what do we make of these graphs? You can, I think it is certainly true that low originations and higher credit scores, they can reflect factors on the borrower side, on the kind of demand for mortgage side. I mean, we know that the financial crisis depleted people's assets that they might use for down payments. People have more student loans. You could argue people are less interested in owning homes, and maybe it's all concentrated kind of in the lower end of the risk spectrum. And so you could explain the charts I just showed you. But at the same time, so some of those factors are probably coming into play. But at the same time, there's lots of evidence suggesting that factors on the lender side are playing a big role holding back mortgage credit. And here, You can look at surveys of senior loan officers who say they really haven't unwound much of the tightening of credit standards that occurred during the financial crisis. If you just talk to banks, they talk about how they're being much more cautious than they used to be about lending because they're worried about kind of bite from the regulators. There are measures out there of how much time it now takes to underwrite a mortgage. It's up to 5 hours. It used to be 1 hour before the crisis. It takes much more time to service delinquent loans. So there are likely to be factors on the lender side that are explaining the tight credit situation. So another interesting feature of the current situation is that the housing share of GDP remains low. And this is a pretty easy one to see. This is just residential investment as a share of GDP. And what you can see is that it's now around 3.8%. So it's down from 5% prior to the crisis. And what people like to point out is that, well, if you took that 3.8 and you brought it up to 5, that would add more than a percentage point to growth over some period. So that fact's true. But then you take these two facts together, and it begs the question, would greater access to mortgage credit boost GDP growth? Well, so here, I'm actually quite skeptical. So first of all, the economy is already at full employment. So kind of boosting mortgage demand, either because of Fed reaction or some other mechanism isn't likely to raise the level of GDP. But I think the other more important factor, and this is something we were just talking about at our lunch table, we've seen this really rapid growth of home prices. I mean, they've snapped back. They're now back to their levels at the peak of the housing boom. And so we've had kind of not much movement in Q and a lot of movement in P, which kind of suggests that there's another constraint there. And I think there are good arguments that the real constraint is with housing supply, either land use regulations or something else that's holding back home construction. Okay, so that's macro growth. Just a few thoughts on the current situation with mortgages and what it implies for risk to the macroeconomy. So one point to note is that given reforms to date and the still tight credit conditions I told you about, there is just much less risk in the system relative to pre-crisis. But then the other important thing to recognize is that most mortgage debt continues to be backed by the U.S. government. So here's a graph that makes this point. This is mortgage originations by kind of type of backer, who's holding the credit risk. And what you can see here, if you look at the gray portions of the bars, which is the GSE securitization, and the black portions, which is those are FHA, Federal Housing Authority loans. That's the government program for kind of lower income, higher risk people. You can see the gray and black. They amount to almost 70% of mortgage originations right now. So this is down from immediately kind of post-crisis when it was up to 90%, but you can see it's still well above where it was kind of in the early 2000s. Okay, so of course the implications here are that if the market were to go into distress, come under strain, the debt is going to be backed by the U.S. government, either through the GSEs or through the FHA. So for that reason, that's probably good news in terms of risk to the economy, although it leaves the taxpayers, of course, on the hook. Okay, so just to sum up those points, the current situation with mortgages, I don't think it's probably a big deal in terms of macro growth, at least in the near term, or in terms of risk to the macroeconomy. But that doesn't mean that we like the current situation with mortgage regulation and mortgage policy. The problem with the current situation is not desirable, it's not sustainable. And what I mean here is that we don't want, it's not desirable for several reasons. We don't want the taxpayer on the hook for all this credit risk. The government isn't particularly good at innovating, so you worry about that with the government having such heavy involvement in the mortgage market. When it comes to kind of the still tight credit conditions, they may not be a big deal in terms of growth and risk to the macroeconomy, but it's undesirable from a distributional point of view. And there are a lot of specific stories. I mean, economists have not nailed this down exactly what's going on, but there are a lot of stories people tell that suggest that kind of the current situation with the GSEs being in limbo and so much lending being done by the government is contributing to the problem. So, for example, in the case of FHA loans, you hear a lot about how lenders are just very worried about making loans that have any kind of processing error, and that's explaining part of their kind of super caution when it comes to lending, because they don't have clarity about what the repercussions would be from the government side. So I think these things would be fixed, if we could have more entry from the private sector into the mortgage market. But what you hear, I mean, this has not been established definitively, but what you hear from people in the private sector is that they aren't coming in because they can't compete with the government. In terms of sustainability of the current situation, this is a somewhat narrow point, but the GSEs right now, they're in conservatorship. They're still, just over 20% still owned by private shareholders, but the current conservatorship arrangement calls for all the profits of the GSEs to go back to the Treasury Department. On the Treasury side, they provided all this support during the financial crisis, and they continue to provide a substantial line of credit to the GSEs. But basically, there are lawsuits by some of the private shareholders that are arguing the situation is not unfair. And the longer this continues with all the profits going to the Treasury Department, it's going to be hard to kind of sustain the current situation given legal challenges and also political pressures. So there are so let me get to GSE reform. There are a number of proposals out there that have come out in the 8.5 years. A lot of them are good, interesting proposals. If you try to read them, they'll probably make your head hurt because they have a lot of complications. But they are out there. The problem is that there are practical and political obstacles that are going to make reform difficult to achieve. And on my list here, first of all, the financial engineering issues associated with mortgage markets, they're very complicated. If you don't have the patience to kind of figure out healthcare reform, try figuring out the financial engineering associated with the secondary mortgage market. So that's a political obstacle. Second complication, and Jim Stock's over there. I worked with Jim Stock on GSE reform in the spring of 2014, and I think this will resonate with him. They're very powerful from a political perspective, what we used to call stakeholders with strong views. So this is the mortgage industry, the housing industry, consumer groups. They have loud voices. And in fact, there was almost GSE reform in the spring of 2014, but it was brought down, at least in part, by a lack of ability to agree about what the affordability provisions would be in the legislation. Third, it's not just a matter of figuring out where we need to go. A lot of these plans say, well, here's where you want to be. It's a matter of how do we get there. And that can be really, really complicated. So there are a lot of people out there who really hate Fannie and Freddie and just want to kind of get rid of them altogether. But I think we need to recognize that the further that we move away from the current infrastructure, the harder it's going to be to implement. And then lastly, there are big uncertainties, including what happens to the cost of mortgages. These are things that you just can't nail down definitively. And what that means when it comes to kind of trying to do reform is that any reform is going to involve winners and losers. The prospective losers are always going to be able to hire someone who is able to argue that, the cost of mortgages will shoot up if you put so much of the system back into private hands. And that's just going to be, those sorts of attacks are going to be hard to kind of shoot down analytically, and that's going to be an obstacle. But I don't want to kind of end on a negative note here. I would say there is good news, and the good news would be that most experts agree about the basics of what's needed when it comes to GSE reform. So like I said, the plans that are out there are a ton of them. It would probably take you weeks to sort through them, but people have sorted through them. And after you do that, you kind of realize that the plans all have a lot of features in common. So here's what's on my list. So first of all, plans out there in general, much greater role for the private sector, including private capital backing more of the risk in the system. Secondly, plans out there generally have the government backing the catastrophic mortgage risk. Okay, so that's one role the government plays, and then importantly, the government has flexibility to do more if the system comes under stress. And I think that this part that I've italicized here, that's a really important kind of point, because there are some plans out there that would just put it all in the hands of the private sector, but history has taught us that the government is going to step in if the mortgage market threatens to go down. So it's better to have this kind of built into a system in there and able to access on an orderly basis than to just let chaos break out and have the government come in. A third feature is that of these plans is that in general the entity that securitizes the government-backed mortgages is a government-run securitizer. And I think this is actually another important feature, because you want to avoid having a too important to fail private entity in this role, or else you're going to end up with an entity that needs to be bailed out. So those are the features in general of these plans. As for the PLS market, which I told you dried up and really has never revived, it's not clear we need to kind of make it come back. My view is that, I've asked a lot of smart people about what their understanding is of why the market hasn't come back, and I think where people come out is that the economics are not working right now, that it's just not profitable to have that market. And I think what needs to happen is we need to really resolve the situation with the GSEs and then see what happens to the PLS market and see if there is some sort of obstacle that's holding it back, or whether it really is just a market that is not going to be profitable to be in over the longer run. So anyway, that's my last slide. I guess my main takeaway would be that even though it doesn't seem like the current situation really is a terrible thing in terms of growth or risk in the macroeconomy, we really should be trying to move towards kind of permanent, longer-term GSE reform. And I think the political obstacles are going to mean that the plan that we come up with may not be the perfect plan from an economist's point of view, but I think as long as what we end up with incorporates some basic features, that we'll end up in a much better situation than what's likely to happen given the current unsustainability of the current conservatorship arrangement, which is that there'll be some sort of modification to the conservatorship arrangement, but basically one that leaves the market in limbo. So that's it.
I'll try to say a few words about bank regulation and try to speak in particular to a couple places where, of the many number of things out there, a couple that seem like they at least might be potentially in play with the new administration. One of these is the stress testing process, the so-called CCAR that the Fed does, and the other is the what's called the Orderly Liquidation Authority. This was Title II of Dodd-Frank. It's the legal authority which basically allows the FDIC to take over and resolve a failing bank holding company. So I'll say a little bit about both of those. But let me just do like a few words of conceptual framing at the beginning, which is I don't think I would have to spend a lot of time convincing anybody in this room that broadly higher capital requirements was sort of a sensible thing for various reasons. So I won't. Okay, but moral hazard. But I'm not going to do any of that. I just want to say I think a piece of it that's underappreciated is the dynamic aspect. It's one thing to say you want to have a higher level of capital. It's another to think about how you rebuild capital after an adverse shock. So I'm going to call this dynamic resilience. And I think this is a very important and somewhat underappreciated thing. And I'm going to try and relate the specific policy stuff to this idea. But just as an example, suppose you set capital requirements at 10%. And you convince yourself that's like a pretty robust thing to do because the worst shock we've ever seen in history was 5%. Okay, so then along comes a shock, and it's only 3%. So the good news is you're still well solvent, and the government's not on the hook and all that. But if you were binding at 10% and you have to be binding again at 10% and they've just lost 3%, 3 percentage points, well, if they don't raise new equity and you don't relax the capital requirement, they're going to have to shrink their assets by 30%. Okay? So from a macroprudential perspective, if you care not only literally about bank solvency today, but about credit creation, asset sales, all that kind of thing, you need to get some capital back in the system. Or I should say, algebraically, you need one of two things. You either need to be willing to relax the capital requirement after an adverse shock, or you need to get capital back into the system. And both of those are sort of important challenges in their own right. So Basel III regime nods at the former. They say, well, of the capital requirement, 2.5% is a conservation buffer, which in principle, after a bad thing, you should be allowed to dip into. In practice, it's not at all obvious that banks will be willing to dip into this because they know they have to get back. Their shareholders know they have to get back. They're kind of in the penalty box until they get back. So they're going to kind of want to get back, and maybe they'll kind of constrain asset growth. And of course, on the latter, the getting new dollars of equity into the system, it's all well and good from a social perspective, but after the shock, the bank's debt is trading impaired, and new money in, this is the classic debt overhang problem, new money in is good for the bondholders, but it's viewed as dilutive, essentially, to the equity holders. So without some force applied, they're not going to just happily recapitalize on their own. Okay, so that brings us to sort of stress testing, and the original, the first stress test, which was done in May 2009, sort of in the depths of the crisis, was quite successful. There are lots of issues. One thing it did that I think was really smart is when it looked at the banks, it didn't say, well, you've got pretty big losses, you need to improve your capital ratio by 2 percentage points, which would have given them the choice between doing it via numerator or denominator, i.e. new dollars of equity or shrinking. It said to Bank of America, you have a $33 billion hole, you need to get $33 billion of capital in. That was, I think, a really central conceptual insight. So, again, lots of things done right and done wrong. I think that was a good thing, and one of the reasons that the banking system was able to kind of bounce back after 2009. So that was, I think, the good part of the 2009 stress test. The bad part of the 2009 stress test is it was done in 2009. For God's sake. I mean, forget about crystal balls. Nobody could see this crisis coming, whatever. By mid-2007, it was sort of happening, okay? Everybody knew. Between mid-2007 and Lehman Brothers, the banks paid out more than $100 billion in dividends and share repurchases while raising very little new fresh equity. That was a massive policy failure, okay? So, even if you couldn't see anything coming ahead of time, the thing didn't just happen overnight. It dragged out kind of over a couple of years before the worst really came. So the failure to recapitalize was a huge policy error. And to me, but a very large fraction of the virtue of doing stress testing is that you will have a process that allows the regulators next time around to intervene and to force new dollars of equity into the system. So, they're stress testing every year, and I think it's great, and you're trying to build sort of a process and a set of institutions, but really the test is going to come next time we have a 2007 and ask, are they successful? Okay? So, as I said, I think stress testing is one of the things where things are a little bit up for grabs, because this is a case where personnel really is policy. It's not about legislative stuff. It's, who succeeds Dan Tarullo, who just left this week in the sort of Fed chair of bank supervision. How you design the details of that test are really, really important. And one thing to recognize is doing it during peacetime, it turns into a quite different exercise. So doing it during peacetime, and this has become one of the flashpoints, is what you're doing is not forcing recapitalization. You can't be doing that kind of constantly in steady state. It has become a sort of off-the-books de facto capital regime. So in other words, whatever Basel III says your capital requirement is, if the stress test is more binding, that is your capital requirement. And the individual weights on individual assets will vary according to that. So for example, bankers will complain, I don't know how valid this is, that the stress test puts a higher effective risk weight on small business loans. Why? Because in the stress scenario, they're assumed to do badly. So one of the things there's a lot of complaint about is there's relatively little transparency into this. And when you set capital requirements in a rulemaking basis, there's a whole set of due process that you have to go through, and you have to put them out for comment and so forth. And this does that kind of a little bit, with less due process. So I think there's a sort of interesting tension here to be managed. And on the one hand, of course, if you're a regulator and you don't really like the rules and you'd like to be tougher, it's nice to be able to kind of bury some of the toughness in the stress test. And I'm absolutely sympathetic. But if you're sort of managing this thing in which your real goal is, I don't want to spend too much of my political capital during peacetime because I absolutely really need as much institutional backbone and toughness as possible, when things get tough, maybe you're willing to kind of open that up a little bit. And I'm not saying, it's an all or a nothing thing, but you could imagine a little bit more transparency on some of these things. Again, not because it's the first best, but it's a second best way of trying to manage this tension. I mean, one thing that was very interesting, and Dan Tarullo just gave a departing speech, he said, another aspect of the stress test has been the so-called qualitative thing, where you can flunk some of these banks basically because the risk management processes are not very good or their computer systems are not very good. He made a point which I thought was very politically shrewd, which is, we've done that and it's been sort of helpful. At this point, it may make sense to take that out of the very, very high visibility spotlight of the stress testing and make this part of the more normal bank supervisory process. It was getting to the point where Citibank was flunked once. The second time their CEO said, if I flunk again, I'm going to resign. So you're putting the Fed in the position of, during peacetime, firing the CEO of a major bank over something that's qualitative and a little hard to describe. Again, I'm making a sort of a purely political point, which is how much do you want to do that and have to explain in front of Congress when the real most important thing is having something that's going to work in a repeat of 2007. So I don't mean to sort of prejudge exactly the answer, but that's the way I would be thinking about where you're willing to dial back and where you absolutely feel like you need to hold the line. Second thing I want to mention is the so-called orderly liquidation authority. So this is Title II of Dodd-Frank. It gives the FDIC the legal authority to essentially act as a resolver of a bank holding company. And importantly, as part of that, there is a piece called the Orderly Liquidation Fund, which allows the Treasury to essentially extend a credit line to a failing firm. It's essentially like a form of debtor in possession financing in case there's a liquidity run against the firm. Okay? That is vulnerable. I think most of Dodd-Frank is essentially not going to be touched because it'll take 60 votes to undo it. Okay? This is different. This one Title II is different. It's different because of this Orderly Liquidation Fund, because it's a budgetary authority. My understanding, and other people who've looked at this say, it can be done under reconciliation, and therefore it only take 51 votes. And there is a not highly economic desire to do this, in part because it has budgetary authority. It's scored. The CBO scores this authority as sort of using up $15 billion of budget headroom. So, if you want to do your favorite other tax reform thing, here's a way to find $15 billion. So this is potentially vulnerable. This is, I think, one of the better post-crisis things. Not that it was going to work beautifully, but at least it was, again, an attempt to take a failing firm to be able to have a bunch of its debt be converted to equity so that the private sector wasn't going to have. But to allow that to happen, or to make that a little bit easier, there was going to be this credit line to kind of prevent a liquidity run at the same time that you are actually using private sector money to recapitalize. So, I don't know how to put odds on this. I think it's still probably, hopefully, less than 50%, but it's it seems to me, a live issue. And that's when I think that would be concerning for financial stability. Also, I think there are very likely to be sort of adverse international repercussions if this goes away. So, for example, the U.S. has worked very closely with the U.K. on all these resolution plans. And, of course, Goldman Sachs and Morgan Stanley and all these guys have very big broker-dealer subsidiaries in the UK. If we basically pull back on our willingness to provide liquidity to these firms, what's the rational reaction for the UK regulators? They're going to want to ring fence. They're going to want to basically do a bunch of stuff to protect their own interests. And given the more general kind of environment around protectionism, I think this could lead to a bit of an outbreak of sort of financial protectionism. What is to be done if things go this way? I mean, I think it's not a good thing. The one very second best thing I would suggest, as part of this process, there has been a debt requirement imposed that basically these banks, in addition to having to have equity capital, have to have a certain amount of long-term debt at the holding company that can be easily converted into equity. Okay? if you don't have any ability to provide liquidity, I would at least want to have a bigger slug of equity at the point of failure so that there's less likelihood of the private market wanting to pull back. So if you took away that authority from me, at a minimum, I think the right thing to do would be to revisit these debt requirements and to think about making them high. Actually, I think that'd be a good thing to do either way, because either way, when the Treasury has to decide to lend, the more it has sort of a big slug of capital, newly created capital, I think the easier is the thing. Okay, so that's it. I think that's one to kind of keep an eye on. Okay, thanks.
I'll just start off saying these are my thoughts and not the thoughts of Fidelity Investments. And I would also mention that I am a market participant. I'm an empirical economist. I am one of those people you have been discussing this morning. Those people who, what's going to happen with stock prices, what are inflation expectations, what's going to happen with the bond market. That's my job. So happy to be here, and if you would like to observe me in the future, please give me a ring. I am going to talk a little bit in defense of, we'll talk about comments on the intersection of regulation, monetary policy, and macroeconomic vibrancy. And I am going to make a defense of price discovery, capital allocation, risk and return, and volatility. I think all of those things are really good things. I think everyone in this room thinks these are good things. I think regulation is a good thing. I think it's also good to understand sometimes when regulation starts to change some of the dynamics in the market. So I'll talk about, I'll be very general, very non-specific, non-theoretical, et cetera, et cetera. What regulations are you talking about, Lisa? I would say maybe it's Sarbanes-Oxley, maybe it's Dodd-Frank, maybe it's the ERISA decisions back in the 1970s, maybe it's the new DOL ruling, maybe it's the Fed's QE policy and ZIRP. All of these things, I think, have affected the market, and some for good and some for bad, and I'm just going to talk a little bit about this idea of vibrancy. So many of you have talked about productivity, and there's just a little chart of productivity, and maybe one of the questions is, why has productivity been not very robust this cycle? Lots of ideas. I don't have one reason for why that is. I do think at the same time we have such a low productivity rate, the share of income that goes to the corporate sector is actually quite high. So that's kind of interesting. That might not make a ton of sense. So why could this be happening? And so I will go back to, I think, what middle school kids learn about when they learn about the Great Depression, or maybe it's what high school kids learn about. But on the left-hand side, I have a picture of the Dust Bowl, which I think all of you know was about monocultures, that you keep planting the same crop every single year, and the soil fecundity falls down, and you hit it with a drought, and all of a sudden the wind comes, and away goes your topsoil, and we have the grapes of wrath, and one of the big contributors to the Great Depression. On the right-hand side, I showed this to one of my colleagues, and he said, "Why do you have broccoli there?" That's two pictures, one on top of each other. One is a top picture of a rainforest, and the picture here with the white square is research that's been done on the vibrancy of a rainforest. Why do we have all these different animals and species and plants and trees and big trees, little trees? And what they did here with this square is they sprayed it with fungicide. They just killed the stuff in there. And what they found was that the dominant species or trees or plants in the forest just boomed. And the competition that was going on in that little square, all the little seedlings, etc., basically got removed, and then the larger got larger, the more dominant got more dominant, etc. Why am I spending so much time talking about this? I do think that to some extent the combination of the regulatory environment that we have and the monetary policy that we've been running may in fact be creating some of these dynamics. I'll mention, I read a piece from Grant's Interest Rate Observer this past week that I actually got permission to give you all a copy, but I think the ecosystem I'm living in is a much less robust ecosystem than I used to live in. That's fine, but I just want to all let you know that it's different. But I put this paper in the other room when I'm done. So let me talk a little bit about a couple of things. These are observations. I told you I'm an empiricist, not a theorist. This is new companies going public, peaks in the late 90s, has continued to go down. And it's not just, it's new listings and delistings, right? So just, that's interesting. This is US firms. This is total firms. This is public and private firms. This is new entrants and exits. So both of those have gone down. So think of those seedlings on the bottom of the rainforest. They're just not coming. The small business formation is not happening. And the big guys are not exiting. Why is that? Is because you're not getting this, proper birth and death in the market. Okay, you're not getting that vibrancy that you have historically gotten. And this is, this is a big long-term chart. Lisa, you're making huge, leaps and assumptions, but I do think this is very interesting. This is the age of firms, and you can see the firms that are 16 years and older, the big trees. That's more than a third of all firms today. Okay, that's a very big change in sort of that ecosystem that we live in. So why is this happening? And I'll talk about sort of four concepts. One is what I call central banks and market dominance. And Karen, and actually both of you, I was so thrilled that you both came before me because, it's important. If the government is the market, it's important to realize you are the market. You're no longer the referee on the field. You are the key player on the field. So I'll talk a little bit about central banks. I'll talk about low rates from a supply side perspective. I'll talk about cheap credit and high visibility and what the reaction of people like me, the market participant, the CFOs of the world, when you give us low rates and high visibility, what do? I'll tell you, I'm sure some of you have a guess. And then price discovery and why it matters. So here we have the yield curves of the three major central banks of the world. We have negative rates in some places. We have ultra low in others. There's sort of two stories I want to tell you. The first is ultra low rates and quantitative easing. Now, I put a picture of Warren Buffett on there, and it's because I'll just I'll make a fairy tale story for you. And the story is that something horrible has happened to Berkshire Hathaway, and it's on the verge of bankruptcy. And Warren Buffett gets up on the podium in front of the television cameras and says, whatever I can do, I will do. And every month, as long as we're in trouble, I'm going to buy $20 billion of Berkshire Hathaway stock. Okay, what do you think Berkshire Hathaway stock will do? It will go up in value, no matter what. Okay, he is going to be a buyer. If I'm an analyst covering Berkshire Hathaway, what's my number one concern? What is the biggest thing I'm trying to figure out? Is, the day that Berkshire Hathaway is a going concern, he's going to stop buying. So I better get the heck out of Berkshire Hathaway stock before he stops buying. Now, quantitative easing, I understand why we want to get lower rates and we want to create that nice positive demand dynamic, et cetera, but it creates a very unifaceted fixed income market. So when we analyze these yield curves, the Japanese yield curve and the US yield curve in particular, and we do a principal component analysis, sort of how many things are affecting how that yield curve moves. Pre-crisis, you know, when the Japanese basically got to ZIRP, or zero interest rate policy, it became a very unifaceted yield curve. When we went to ZIRP, we became a unifaceted yield curve. So there's very few things moving this thing around. There's not lots of price discovery and buyers and sellers and movers. It's the Warren Buffett, which happens to be the central bank at this point, really affecting the price. The other thing that's going on, and I apologize, this is really basic stuff, but this is a price control. You introduce super low rates, you have a price control. And your willingness to extend credit into a market where you're not allowed to charge the price you want to, you will offer less. And so, for example, the mortgage market, there's lots of things going on in the mortgage market, but why does the private sector not want to get back into this market? Part of it is they can't price it appropriately. So that's something to think about, that there's a supply side effect of ultra low rates, not just a demand side effect. You know, in terms of vibrancy, I think it's interesting. We have another aspect in the market, which is we have passive investment vehicles. Passive investment vehicles are, let's call it SPX, or the index S&P, or the low vol ETF, or the HYG high yield vehicle. These are vehicles where you buy the basket. You don't have a discussion, well, I think, you know, this is cheap and this is expensive and I really like this management or I don't like this management. You buy the basket, period. That's a third of the US equity market today. So all I'm highlighting is that those baskets do not do a market analysis. They just buy what the market tells them to buy. And we can see that again with principal component analysis. So this is just what number of factors explains 50% of the variance in the Russell 3000. We can see sort of these big macro shocks that we saw post-crisis, the GFC, the European banking crisis, the debt ceiling crisis, et cetera. But generally, the amount of sort of signals that we have in the market is getting less and less. So again, just think of those, that forest floor, just a little less dynamic than it used to be. And then I just want to talk about a lot of talk about expectations and, you know, response to expectations and signaling. And yes, the central bank has been extremely clear about what it wants to do with rates. And yes, they have made rates extremely low. Now, if I'm a CFO of a company, my bread and butter is this thing called ROE, return on equity. This is the DuPont model. It just decomposes where does ROE come from. And the world is a scary place. You know, certainly 2010, 2011, 2012, we still don't really know what's going on. What's the tool that I use again and again and again? And that is the seconds from the last, which is leverage, okay? So the US non-financial corporate sector has been using leverage. They've done exactly what you wanted them to do, sort of. They didn't really invest. They just used leverage. So, you know, this is what we've got. It's maybe not my favorite piece of news. You know, I'd much rather have us investing in vibrancy and operating efficiency and all those good things. But this is maybe one of the things to think about going forward. So those are my thoughts, and I'll take it off.